All right, guys, 3M stock. I'm going to tell you something. I've started a position in 3M stock. Now, first off, do not buy 3M stock just because I did. You need to do your own homework. I've never bought a company just because a big investor has, ever. Look at Warren Buffett. He's buying Apple. I am not touching Apple until much lower prices. If I can do that to Warren Buffett, you can certainly do it with me. I will show you why I bought 3M, but again, you should not buy it just because I have. Mo, did you start a position in it?
No.
He did not. So look at us. Mo did not start a position. I did. Yeah. And the great news is I want people in our community fight me on this. Reach out to me and tell me why I shouldn't have bought 3M. Tell me, Paul, you're wrong, and here's why. And there are concerns I have about 3M, but we'll go through it and we'll understand it. But again, you're never to buy or sell anything just because I've bought or sold it. Ever. Ever, 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 ever. You have to think for yourself, and we're here to teach you how to fish, not to give you fish. So let's check out 3M in our software. And it's funny because in our community, everybody always say, Paul, we know you have to be careful and all that stuff. I'm like, listen, we take regulation very seriously. So whenever we tell you that we bought something, you're not to buy it just because we've done that. If you do, that is a bad decision. But do your own research, learn how to fish yourself. So 3M stock is down quite a bit from its all-time high of 260 in January of 2018, Mo.
Wow.
This is 3M, Mo.
Yeah. I mean, probably everybody that's watching this, somewhere in your room, you probably have a 3M product.
100%.
They make the weirdest stuff.
We have two of them right there. Look at the Post-its right there. It says bull versus bear and pitch.
Yep. Those are 3M.
Oh, those are 3M too.
Everything is, there's so much 3M everywhere.
Yeah. And here's the first thing I don't like about 3M. $55 billion market cap.
Ooh.
And look at this enterprise value. The difference here is the debt. It's a big difference. However, I will say this, Mo. Their long-term debt to free cash flow is only 3.8.
Oh.
So their long-term debt of this debt is only like $16 billion. And if you go to the balance sheet, we can scroll all the way to the bottom and see total long-term liabilities, $21 billion.
Yeah.
Okay, so it's 3.8 times. There you go. Okay, so it's still a lot of debt, but it's a big company with very consistent, look at this, Mo. 5-year profit margin of 16.4, 1 year of 16.3. Do they consistently make money?
Consistent, yep.
6.1% dividend
That's
yield.
what I was looking at right now.
It eats up a big chunk of their free cash flow, but guys, how is 3M gonna grow?
Yeah.
Like, can you make another Post-it note, please?
Maybe
Like,
maybe we could wild colors.
Well, I'm sure they already have that.
They beat me to it.
Look at this enterprise value to earnings, 15 times. I mean, that's incredible. Return on equity, 37. Return on invested capital, 14. So guys, the great thing about this is when 3M does find an area they can invest a lot in,
they do it.
Yeah, and they get a high return on their money. Yeah. But in the meantime, if they don't have that, guess what they're doing? They're paying it out in dividends. Mm-hmm. That's what we want to see. So they're paying, I'm okay with dividends if they have no other use for the money because I don't want them wasting their money, wasting my money as a shareholder on making bad acquisitions and other investments.
Buying back shares too.
They're buying back shares.
Yep.
10 years ago, they had 675 million average diluted shares outstanding. Now it's 553.
Yeah, they're buying back stock at 11 times the trailing 12-month earnings.
Right now they're at 10 PE. Buy the crap, and as the shares go down in price, keep buying back more shares. I want to buy some more too. Mm-hmm. I'm going to buy more shares. Now, guys, my guess is this stock will be a lot cheaper at some point in the future. Mm-hmm. Why? Because I think the market's just really overpriced. If you're in our community here, if you subscribe to our channel for only $1 a day, you get the software, and every day I put my stock market to GDP ratio in there, and we're still, according to history, going back to 1929, 70% overvalued. So my guess is that a company like this will probably go down. Will it hopefully go down less because the PE is already low of 10 and the dividend yield is high? Yeah, I hope so. But dividend yield being at 6%, is that stable? Well, look at this free cash flow last year. It dropped from their 5-year average from $5.5 billion down to $4 billion. And their dividends eat up $3.3 billion of that. So how do you buy back shares and pay that dividend and do all those things?
Right. That's very difficult to do.
So maybe the dividend will stick around. Maybe they'll cut it. Even if they cut it in half, I'm happy with the 3% dividend yield as long as they're buying back. Hell, guys, if the stock fell in half today, I would tell them, cut your dividend and just buy back tons of shares. Because this is not taxable. And what's the stock buyback rate? 1%?
Yeah.
That stupid thing.
Yeah.
All right. Let's look at their cash flow the last 5 years and see why there was a big change in the last year. I mean, look at this consistent cash flow, guys.
I know.
4.3, 5, 5, 5, 4, 5, 7, 5, 6, 7, 5, 4.
Very consistent. The last decade has been consistent with the exception of a COVID bump.
I mean, guys, this is like, to me, this is why I'm liking this. Let's go to our 8 pillars. 2X's. Usually the 2X's are these two, PE and price of free cash flow. Free cash flow is down, fine, and net income is down, fine. It's a very consistent company. And the revenue growth is not going to be big. Not going to be big at all. Let's look at the revenue growth.
Yeah,
I mean, they've been stuck at 30 billion for the last 10 years.
Might even start shrinking.
Maybe so. So let's do our stock analyzer tool. Mo.
Yeah.
If I told you 3M was gone in 20 years, would you be surprised?
Yes.
Yeah, I'd be absolutely shocked.
Yes.
I'm going to do a 20-year analysis. Mo, do you mind doing a 10-year analysis? Sure. Actually, why don't you do a 5-year analysis? Let's do it a little bit different.
All right.
So we're going to do a 5 and 10 and 20-year analysis. And the reason being is I want to buy companies I want to own for a long period of time. And if 3M falls 50%, but my thesis is still the same, I want to buy back more shares to make even more money in 20 years. If you can't do that, you should not be buying individual stocks. You absolutely should just stick to ETFs. But if you want to get in the individual stock game, this stock analyzer tool has changed the game for people in our community. 1.3 million times it was used last year. It doesn't include the balance sheet, but it gives you a value of the business based on the future projections of your earnings and free cash flow. Let me show how it goes. First line, revenue growth. Guys, look at this revenue growth. It's absolute crap. So let's be a little conservative. Let's call it negative 1% over the next 20 years. Let's call it 2.5, and let's call it, actually let's go 2, and then 5% revenue growth. So I did a low, middle, and high. I did negative 1%, 2, and then 5%. Profit margin, it's the same. I'm just going to keep it the same all across the board.
So I just shook my head. I was like, how do I change this?
Free cash flow, I'm actually going to do the exact same thing again.
It's very consistent. It's a consistent business. That's
now,
the thing about it.
Now for PE though, this is something I'm doing I'm doing this different than I did the last 3M video. If I'm assuming negative growth, I need to make my money through an earnings multiple. So I'm going to go 8, I'm going to go 10, 14 and 18 PE and price of free cash flow. Because I think their brand name, if they're able to get back to decent revenue growth, should sell for a premium to the market. Because it's a high moat business. Look at this 10-year ROIC, 16.5%. This is a sign of a moat that they can get and maintain a high return on invested capital. All right? That's the big key. Now for my desired return. Guys, I've made some really low assumptions here, so I don't need as big a return. Now I've made some pretty high assumptions here, so I need a bigger return. And the bigger return you want is a higher margin of safety, right, Mo? Mm-hmm. So Mo, why don't you tell me what you want to do for these desired returns?
I put it in 10, 11, and 12, but my spread was very different from yours. So if I was you, I'd go a little bit higher.
I'm doing 10, 11.5, and 13%.
Okay.
All right?
Yep.
Because on the low side, even though the market can do 10%, I'm buying up what I think consider to be a top quality business, better than the market, better than the overall average of the market. And I'm okay making 10% on that one.
Yeah.
So I'm hit the analyze button. Mo hit it too.
Yep.
Low price, 89. High price, 140. Middle price, 109. It's currently my watch list at $95 because I want to notify me again so I can start selling more puts on the company. What'd you get, Mo?
So mine's 81 to 116, middle ground about 100.
Okay, so you're basically there too.
And I didn't have a lot of fluctuation in my numbers.
And yours only a
because
5-year
it's 5
analysis.
years, so I don't really see them declining in 3% revenue over the next 5 years. Like, I think -1. I can see all of these situations being reasonable.
Yeah, and I look at this saying,
change a lot.
Yeah, I look at this saying, guys, at some point this company's got to get into paying down debt and buying back even more shares, especially as the stock goes lower. Mm-hmm. So guys, again, don't buy this company just because I did. It's going to end up costing you in the long run. But sit there and learn a process. When you learn the process, you will become more free. You will feel better about yourself. Check out everythingmoney.com as a way to start. $1 per day for 7 days. Check it out. It'll change the way in which you look at money.